It was another day of losses for the Indian market. The Sensex fell for the fourth consecutive day and ended at 28-month low. This was because foreign institutional investors continued to sell Indian equities on mounting concerns of slowing growth and political paralysis. The Sensex ended down 112 points at 15,379. Investors are also concerned about the impact of the impending food security bill, which was given a green signal by the cabinet over the weekend. Analysts said that this would weigh on the fiscal deficit target as the subsidy bill would go up by Rs 28,000 crores. Also over the weekend, foreign research from CLSA cut the target for Sensex to 11,000 to 12,000 due to high interest rates, weakening rupee and high inflation. CLSA cut India's weighting to neutral from overweight. Also, today's rupee weakened further and closed near 53 levels. So, Pramit, what is the impact of the weakening rupee on the Indian economy?
Yeah, there are several risks because of the depreciation of the rupee. One is, of course, the foreign exchange risk. Several companies have foreign loans, and they would get hit as the rupee depreciates. Also, we need to keep in mind that foreign investors have largely shied away from the Indian market this year, and an expected depreciation of the rupee would tend to put them off. Given that we are already facing a scenario where almost all the macroeconomic indicators you can think of, whether it's inflation, whether it's interest rates, whether it's the fiscal deficit of the government, the external sector, the rupee, everything put together makes for a particularly bleak scenario. And when you have someone like Christopher Wood of CLSA saying that Sensex could fall to 11,000 to 12,000 levels, that bank loans could non-performing loans of banks could get worse, obviously it affects investor sentiment because he's regarded highly by most fund managers of India.
As Pramit said, the CLSA has said that the rupee may touch 60 levels going forward. Year to date, the Sensex has fallen 25% as foreign institutional investors have sold almost 3,000 crores in Indian equities. So, Pramit, what is the road ahead for the markets?
Well, the road ahead does not look particularly bright. If you see all the economic indicators that we can consider, whether it is inflation, whether it is interest rates, on the external front, the current account deficit, the rupee, on the government side, the fiscal deficit of the government, they are all heading south. They have all weakened. And so fundamentally, there is a problem, and I admit that there are a lot of these negatives have been factored in, but as the recent Morgan Stanley report showed, India still remains the most vulnerable to any funding shock globally among Asian markets. Hence, unless there is some coordinated policy action, there is some impetus at policy reforms, it's unlikely that the markets will see a sharp rally.
As Pramit said, the Indian markets may continue to see rough weather. Amongst the sectors, banking shares were the worst hit, with ICICI Bank, Punjab National Bank, State Bank of India all falling to two-year low. Also from the capital goods space, Larsen & Toubro touched 31-month low, down 4%, followed by BHEL. Amongst the gainers were Coal India and Reliance Industry up 2%, followed by Tata Motors that was up 4%.